Saturday night, January 24th, 2026. While everyone's glued to weekend headlines about Trump floating a 100% tariff threat at Canada, something else quietly lit up today. It's the kind of detail that feels minor until you realize it links trade policy, metal shortages, and credit stress into one chain. Before we dive in, quick favor, hit like and subscribe right now. We publish original, source-based breakdowns, and the next 48 hours could get noisy. If you want the update before the mainstream even notices the problem, you'll want the next upload in your feed. Here's what the crowd saw: a headline and a hot take. Typical political drama, negotiating leverage, it'll blow over. Here's what almost nobody noticed. About 30 minutes after the tariff story started circulating, silver snapped higher in Asian overnight trade. Fast, clean, and on a weekend. That move didn't originate in New York, and it didn't originate in London. It showed up where physical demand gets priced like a necessity, not a suggestion. And it didn't happen in a vacuum. It landed on top of a price gap that's been sitting there for weeks. On some feeds, Shanghai has been printing silver roughly $10, $50 above the US reference price, while New York has been fighting to hold lower levels. That's not a fun fact. It's a stress test, because a spread like that is supposed to close. In a healthy system, arbitrage squeezes it shut. Metal flows, paper contracts link markets, and the gap disappears. When the spread refuses to close, it usually means one of two things. The metal can't move, or the financing can't move. Now connect it to Canada. Canada isn't just a trading partner, it's a crucial upstream supplier for North America. Silver, gold, platinum group metals, concentrates, refined inputs. If tariffs of that scale ever move from threat to policy, it wouldn't just raise prices, it would break contracts, crush margins, and turn routine sourcing into a deal that no longer works. Here's the part most people never learn about precious metals. The supply chain runs on credit. Mines produce, refineries process, wholesalers distribute, dealers sell. But metal moves because payment terms exist. Letters of credit, inventory financing, hedging, settlement windows, and, above all, trust that tomorrow's rules won't blindside today's shipment. When trust gets hit, credit tightens. When credit tightens, the physical market chokes. That's why a tariff threat matters even before a single tariff is collected. It injects rule uncertainty into a system built on predictable clearing, and that brings us to the next signal. A letter attributed to Dr. Tyler Wall, CEO of SD Bullion, has been circulating, and his description isn't "demand is strong." He calls the wholesale market chaos, an absolute circus, because the middle layer is running out of oxygen, credit capacity. Plain English, the firms that bankroll large inventories are hitting their limits. Lines are maxed, terms are tighter, risk desks are pulling back. So even with record prices and buyers willing to pay premiums, some wholesalers are refusing certain products, not because they hate profit, but because they can't fund the carry. That creates a nasty paradox. Headlines say silver is up, while delivery times stretch, allocations shrink, and in stock quietly becomes call for availability. Screen prices can glide upward while the shipped, delivered market grinds and sputters. And timing matters. If the credit stress existed before the tariff story hit, today's move is less reaction and more confirmation. A weekend policy shock is exactly the kind of trigger that forces stressed systems to show their cracks. One more thing before we go further. This channel tracks dealer memos, shipping routes, refinery throughput, and the paperwork nobody wants to read. Lately, we've seen copycat accounts recycle this research with zero attribution, then pretend they discovered it, so stick with original sources. Now, about that gap again, people say Shanghai trades different because of taxes. And yes, local frictions exist, VAT rules, import quotas, contract specs. But those excuses don't explain a persistent and double-digit spread when global inventories are supposed to be mobile and arbitrage is supposed to be ruthless. When the premium stays wide, it usually signals one of two realities. Metal is not actually available to ship, or the economics of moving it are broken. If credit is tight, you can't bankroll a cargo. If policy risk rises, you can't price the landing cost. This is also why weekend moves matter more than people think. Thin liquidity doesn't just mean small volume. It means price can jump to the nearest level where someone is willing to take the other side, and in a stressed market, the other side disappears. So when silver moves hard on a weekend and the move is led by regions that care about physical supply, you treat it like a siren, not a meme. Now bring Canada back in one more time. A tariff threat on a key supplier doesn't only affect raw metal, it hits refined product, fabrication, and downstream components. Solar, electronics, medical equipment. These industries don't buy a chart, they buy material. If they think cross-border flow might get interrupted, they front-run the disruption. They secure inventory early and pay the premium. And that loops back to credit. When demand gets pulled forward, wholesalers need more financing to carry more inventory. It's a signal that the mechanism equalizing global pricing is losing strength. So price discovery becomes regional. Your price depends on where you are, who you buy from, and what can actually be delivered to your doorstep. Because once regional pricing takes hold, the global price becomes a soft suggestion, and the real price becomes the delivered price, shaped by shipping, policy, financing, and how desperate the next buyer is to secure supply. So don't underestimate what a weekend headline can do when the system is already strained. It's not the headline that breaks the market. It's the headline landing on a market that was already cracking. Now, in a moment, I'll tell you the 3 signals I'm watching as electronic markets reopen, and the one indicator that matters most. Now, as electronic markets reopen, you don't need a crystal ball. You need a checklist. If this is a weekend headline that fades, the checklist stays calm. If this is a structural break, the checklist starts flashing. Number 1, the spreads. Watch whether the US paper benchmark jumps, then watch whether physical premiums jump even more. If tariffs make Canadian supply harder to land in the US, the arbitrage window should close fast, either by US prices rising or by availability tightening until prices are forced higher. Number 2, the credit plumbing. If the wholesale layer is constrained, you'll see it in behavior before you see it in headlines. Look for dealers quietly reducing max order sizes, delaying shipping windows, switching to wire only, widening buy-sell spreads, or refusing to quote certain items. Number 3, the geopolitical risk premium. This weekend has carried chatter about heightened U.S. naval posture in the Middle East, including mentions of the USS Abraham Lincoln Carrier Group. Whether every detail is accurate or not, risk perception is the fuel. When managers model disruption, inflation risk, and currency uncertainty, they rotate into hard assets fast. But the single indicator I care about most is the China premium, the Shanghai to New York gap. If the system is normalizing, that gap compresses. If the system is fracturing, that gap widens. A widening premium is the market's way of saying delivered metal is more valuable here than your global reference price admits. And if that premium stretches into a number you can't explain away, $20, $25, $30, then we're not talking about volatility. We're talking about a split reality, a paper price on screens, and a location-based delivery price in the real world. Once regional pricing takes hold, the paper market becomes a weak compass. You can buy exposure all day, but if a large wave of buyers demands physical settlement, the chain gets stressed where it's already weakest: inventory and financing. That's when quotes still print while product quietly disappears. Now add a detail that's been popping up behind the scenes: vaulting. Over the last several days, multiple vault and storage operators have reported a surge in serious inquiries: private vaulting, offshore storage, non-bank facilities. Normally, they see a steady drip. Suddenly, they're seeing a rush, and the questions are specific: onboarding, insurance, title, delivery logistics, jurisdiction. That doesn't look like casual weekend panic. It looks like bigger money doing paperwork ahead of a potential repricing. Because storage only becomes urgent when you think availability might matter more than price. So what scenario makes institutions care about storage right now? Try this on. If wholesalers are capped on credit, they can't scale distribution even if mines keep producing. If tariffs increase friction on a major North American supply route, material flow slows and premiums rise. If Asia keeps paying up for immediate delivery, more metal stays local instead of moving west. Put those together and you get the same outcome every time. Screens can trade, but physical delivery becomes the bottleneck. And there's another layer that rarely gets discussed outside industry circles: form factor. A silver ounce isn't one universal object. There are 1,000 Oz bars, good delivery bars, kilos, coins, rounds, industrial shot, and contracts that reference one thing but settle as another. When markets are calm, conversion is routine. When markets are stressed, conversion becomes friction: time, fees, fabrication capacity, and queues. That's when you see futures up modestly, while common retail products jump in premium. So, if you want a real-time read on stress, watch for mismatches between paper price and dealer premiums, spot and wholesale bid, TOSH or ask, available and ships in weeks, buyback offers, and published spot. Those mismatches are the footprints of a shortage even when the chart looks orderly. Also, watch whether immediate delivery trades with a premium to later delivery. When near-term metal is bid higher than longer-dated contracts, it's not a mood swing. It's a signal that getting metal now is more valuable than promises later. None of this requires a conspiracy. Stressed systems can look coordinated because everyone reacts to the same incentives at the same time. If credit is tight, everyone hoards liquidity. If policy risk is high, everyone widens terms. If a region is paying up, flow gets pulled that way like gravity. But timing still matters. Weekend headlines hit when positioning is thinner and liquidity is worse. That's how you get opens that feel like they came out of nowhere, even though the pressure was building all week. So here's the practical takeaway. Don't treat Sunday night like entertainment. Treat it like the moment the market votes on whether the pipes are clearing or closing. If the vote is closing, you'll likely see three things at once. Paper up, physical premiums up more, and availability down. And when those three happen together, people stop arguing about narratives and start asking one question. Can I actually get it? Markets don't move on what's true. They move on what has to be paid to settle the next transaction. If the settlement cost starts migrating upward because of credit limits, tariff friction, and regional demand, it can overshoot brutally before it stabilizes. So I'm watching the same charts you are, but I'm also watching the boring stuff. Terms, delivery windows, dealer spreads, and the Shanghai premium. If we wake up Monday and that premium is wider, not tighter, that's your confirmation this is bigger than a headline. I'll post the follow-up as soon as we have clean reopen prints and confirmation from physical indicators. Hit like, subscribe, and turn on notifications so you don't miss it. One more set of tells if you want to get ahead of the commentary. Watch whether lease rates and short-term funding costs spike. Watch whether exchange for physical spreads widen. And watch whether registered or deliverable inventory numbers start getting talked about more loudly. Those are the plumbing gauges, and when they move, the chart usually follows. Also pay attention to substitution behavior. If suppliers start offering equivalent products, switching bar sizes, or delaying certain SKUs while pushing others, that's not random. That's a sign the market is working around a constraint. And if you see a sudden wave of temporary rules, new minimums, new payment terms, longer settlement windows, treat it as information. Rules only change when risk changes. The point of all this isn't to panic. It's to read the signals correctly and to understand the difference between a quote and a delivered reality before the crowd catches up. If the pipes seize, repricing can happen in hours, not weeks. And once premiums reset, they don't always snap back instantly.